This is Money Talks.
Hi, my name is Ibukun Oyedeji, President CFA Society Nigeria. Join me and a host of other financial industry practitioners for Money Talks with CFA Society Nigeria.
Money Talks with CFA Society Nigeria. Let's talk about money. Hello everyone and welcome to Money Talks. Money Talks is brought to you by CFA Society Nigeria and is a financial literacy program. Smart Uzechi is my name. You can call me Captain Smart. My guest today on the program is Hannah Agbai, CFA. Hannah Agbai holds a Bachelor of Science degree in accountancy from the Nnamdi Azikiwe University, Awka. She's a chartered accountant and a chartered financial analyst, CFA. She has 5 years of experience in financial control, human resources, and research analysis. Currently, she is a Treasury Associate at Investment One, where she is responsible for managing the trading of global financial assets. And this evening, we're going to be discussing basics of interest rates and how they impact financial well-being. You heard me there, basics of interest rates and how they impact financial well-being. And you sit back and join us on the program. You can call the telephone number 0700 923 923 923. That's the number to call us. That's 0700 923 923 923. You can also call 0802 054 4484 or send us messages on WhatsApp 0817 313 6193. Remember, you can join the program via the CFA Society social media handles. You can go to the website www.cfasocietynG.org, or you can go to LinkedIn, Facebook, YouTube, and Instagram at CFA Society NG and join the conversation right there. Even as we say hello to our guest this evening, Hannah Agbai. Hannah, good evening to you and welcome to the program.
Thank you, Captain Smart. Good evening.
Good to see you. How are you doing?
I'm fine.
All right. So Hannah and I will begin the discussion just when we come back from this very short break. Please do stay with us.
Money Talks.
Money Talks.
Money Talks. Money Talks. Money Talks with CFA Society Nigeria. Let's talk about money. Welcome back to the program. Hannah Agbai, CFA, is my guest on the show this evening. Basics of interest rates and how they impact financial well-being is our subject of discussion right here. Hannah, one more time, it's so good to have you on the program.
Same here. Thank you.
So Hannah, let's get straight into the conversation. We're talking about interest rates, basics of interest rates and how they impact financial well-being. And I'm sure it's one that people will want to pay attention to, because when they're talking about interest rates, it affects everybody, particularly the banking public. So just walk us through it. What are interest rates? Because many people may not understand, even when at the end of the month they see an entry in the account that says either a debit or credit interest. So just tell us what interest rates are, the different types, and how do they differ from one another, because not everybody understand that banking language.
All right, so we can view interest rates in two different ways. It can either be the cost of borrowing money or the return on an investment. So when you look at interest rates, we have different types of interest rates. You can say, we have a fixed interest rate, variable interest rate, nominal interest rate, and real interest rate. So what are these terms? When you see a fixed interest rate, you have an investment, you have a loan, a borrowing, and you're paying a particular cost on that loan every month. It's not changed. You have a fixed rate of like 15% and you pay throughout the life of the tenor. That's what we call a fixed interest rate. And when you're looking at variable interest rates, it means that the amount you pay varies according to changes in general market interest rates. And then you look at nominal interest rates. It is an interest rate that has not been adjusted for inflation. And also real interest rate is when you've adjusted it for inflation. An example can be you get a rate on an investment of 20%. That's the nominal interest rate. But we know inflation right now is at 33%. So if we look at it, you're actually not gaining anything if we factor in inflation. So the 20% is the nominal interest rate, while the difference between 20 and 33, that's 13%, is the real interest rate that you're getting, which is negative. I don't know if that helps.
Wow, that's a lot of CFA material. Right there, a lot of CFA material at CFA level.
Okay.
So you just try and come down to our level.
Right.
We that have not gone to CFA and have CFA behind our names. So in order to break it down more, so can you tell us, because when people come out and say the interest rate is this, or they have gone to MPC and the MPR is this, it's going to affect interest rate, people will just be asking, this interest rate self, how do they determine interest rate, and why are there different rates for different people or different companies? Why don't we just have one size fits all?
Okay. Okay, so how are interest rates determined? Is actually determined by the central bank, just like you said, MPR, MPC. And these rates are determined at the Monetary Policy Committee meeting, which is MPC, and the monetary policy rate, which is MPR. CBN determines that. How did they do that? They look at what is happening in the economy. They look at inflation. They look at what is happening in the local and then in the global space. All these things happening, how should we affect that in the interest rates in the country? So when you look at that, they determine the interest rate, and the current interest rate is around 26.75, which is the MPR, is the policy rate, and is the benchmark rate. That is the rate which banks use for their lending, for their borrowing, just like I said, the benchmark rate itself. And why are there different rates for different people? Of course, we know that different people have different needs. So Mr. A might have a good collateral, Mr. B might not have a good collateral, Mr. A might have character. You look at all of those things, you look at collateral, you look at, what's the tenor of this rate? Is it different? A 1-year loan, the rate is actually much lesser than someone collecting a 2-year loan. So because the dynamics are different, the rates will be different for everybody. But the policy rate, which is what central bank set, determines the benchmark for which different banks or different financial institutions price their rates at.
So as things are very difficult now, what can they reduce the interest rate? As things are very difficult now, things are expensive.
Yes.
What can they reduce the interest rate so that people have access to finance, at cheaper rates?
Okay, so why is the interest rate high at this point?
Yeah.
Interest rates are high because of inflation. Inflation is currently at 33%. So what causes inflation? There are two different things that causes inflation, either from demand or from cost. So if you reduce interest rate at this point, it makes borrowing easier. People can easily borrow, you can easily buy whatever you want to buy, and it fuels inflation. But if interest rates are very high, it kind of minimizes your consumption. You tend to save your money, you tend to think twice before you do anything. So all of these high interest rates is just to curb or fight inflation at the moment, because it's at 33%, which is very high.
In case you joined us now, it's Money Talks. Money Talks is brought to you by CFA Society Nigeria. It's a financial literacy program, and you can attest to the fact that our guest in the studio this evening is lecturing us on these things. I'm sure you're taking notes right there. You can join the conversation now. You can call us on the telephone number 0700 923 923 923. That's the number to call, 0700 923 923 923. You can also call 0802 054 4484. That's 0802 054 4484, or call 0817 313 6193. That's 0817 313 6193. Send us a message on WhatsApp to that number, or you can send a voice note to that number if you have questions around interest rates, how they arrived at, or there's something you want to clarify about interest rates, maybe with your bank or something, or your finance house, something about interest rate and all of that, and how it is affecting your financial well-being. That's what we're discussing here this evening. You're welcome to talk to us about that. And I can tell you that Hannah is very well qualified. She has the answers for this evening. So Hannah, okay, before we go forward, we'll have a call on the line. Hello, good evening to you.
Good evening, sir. This is James Obona from Oshodi.
Thank you, James, for calling. Let's have your contribution. Yes, we can hear you. Yeah. Oh, we lost the call there. You try to call us back 0700-923-923-923. There's also 0802-054-4484. Those are the numbers you can call, or send us a message on WhatsApp 0817-313-6193. That's 0817-313-6193. So Hannah, I was going to ask you the implications of these differences in cost as you have enumerated them, in cost of borrowing for individuals and businesses as well. Will you answer after we've spoken to this caller? Hello, good evening.
Hello, good evening.
Thank you. Thank you so much for calling. Welcome, sir. Go ahead.
Yeah, please, I want to ask.
Yes.
Let's assume you borrowed ₦1 million, right? And you are paying interest on the money, say 10% or 20%. Then say you are paid up to like 2 months.
Yes.
And you use the money for business and all that, and you now decide that, or because you've seen the money and decide to pay off the main amount of money you borrow. I mean, what will now happen?
Okay. All right. So just listen.
Are you going to continue paying the interest?
Okay.
Or are you going to terminate it because you have paid off the main principal?
All right. Okay. Hannah is going to provide the answer. So this person has paid off the loan before the expected expiration. So he says, what's going to happen?
So if you pay off your loan before the expected tenor, it means you've paid off all your loan, because the interest must have accumulated. It depends on what this thing you take. If it's on reducing balance, you pay the first month, then the interest you pay the second month. So by the time you pay that way, by the time you finish paying or paid everything by the second month, I don't think you should have anything left to pay, because the interest should be reading on the reducing balance or how many months you collected the loan. So it wouldn't be for the, let's say, 1 year you took the loan, but for 2 months that you took the loan and then you paid back what you own as a that's
all right. Hello, good evening.
Yeah, Captain, good evening, sir. Can you hear me now?
Yes, we can hear you. Tell us your name and where you're calling from. Yes.
Okay, so thank God that this is a topic we have been discussing, because I've been asking questions about this interest rate and all of that. Now, I want to ask, this 26 point something that they put as the MPR. The question now is, if I go and borrow money from the bank, if I borrow, let's say, 100,000 from the bank, and I'm paying 26% on top of it as interest, it means that what I'm getting is around 74% of the money. That's what I'm getting. Because I'll be paying 26% as interest. So the question is, what business will I do? I will generate, that will give me profit for myself. I will be able to pay that 26%. It means I'm paying 126,000 on top of the 100,000 that I collected, for instance. So that's one. So I want her to help me answer that. Then secondly, the negative side of this interest rate, she said that is to keep people from borrowing. Negative side is all these bonds and all these things that government is selling, and maybe shares and all these things. And if they are less than because most of them are 17%, 18%, they'll tell you as profit. So, and the damage is less than even the interest rate of the money you are collecting. So, what is the wisdom there in buying government bonds and stuff like that? It's not even up to the current interest rate in the country. I don't know if she gets my question.
All right, thank you very much. Over to you, Hannah.
Okay, so I'll start from the second one. Yes, you are right. We are currently at a negative rate return at the moment. It used to be very bad as at the beginning of the year, but it has improved. Like, yes, inflation is at 33% and most of the government bonds are at 20%, so you are getting minus 13%. But if we look at it from the beginning of the year, rates were as low as 10%, 11%, so negative return were around 20% and higher. So yes, right now we've not seen a positive real rate of return. So what you do is rates are much better as at beginning of the year. So it's better you put it in at this moment, even though it's negative, but it's still something compared to just leaving it in the bank or just leaving it out there saying, oh, it's negative real rate of return, I don't need to do anything. It's still something.
You add this question that's coming. Hello, good evening.
Hello?
Yes, good evening to you. Welcome to the program.
Hello?
Yes, I can hear you. Okay, please go ahead. Go ahead. We lost the call there. So the first question the caller asked.
Yeah, so he was saying where would he put
now
what investment?
Paying, 76%. That's how much he's getting, and what business is he going to do to be able to cover up the money?
Yeah, so that's
profits.
the effect of higher interest rate on the economy. It slows down the economy, slows down businesses. Just like you said, if I take loan of 26-30%, where would I put it? So you have to now think of an investment that would give you something above 30%, which doesn't come by so easily. So that is one of the effects of high interest rates. It slows down investment. But if you look at it on the other hand, inflation is also something that we need to curb, because inflation reduces the purchasing power. So if inflation is high, even the business you are doing, you will not make so much, because every day you go to the market, things keep going up. So we need to actually fight inflation first, and then by the time rates reduce, you can see lower interest rates to take for loans and the rest. So
back to the question I asked, the implications of differences in cost of borrowing for individuals and businesses, what would they be?
Okay, so if we look at it, so differences in borrowing and everything. Person A borrows at 20%, person A borrows at 25%. Of course, it affects their investments. Someone who borrows at a lower rate is much open to spend anyhow he or she wants, is more open for business expansion. But someone with a high interest rate who gets it at a higher interest rate, of course, is not out there to spend on businesses, on investment. So person who borrows at a higher interest rate tends to manage money, tends to actually look at, think well before actually going into any business or something like that. So I feel like for different individuals, it affects their spending, it affects their investment plan. It also affects in terms of investment decisions and how they want to even repay these debts. Because if you take it at a higher rate, how are you actually going to fund these debt repayments? And some businesses will end up transferring this cost to the consumer. So different rates affect different individuals in
different ways. Okay, that's one side of the coin. The other side of the coin to borrowing is actually savings and investments. You've been talking about that, so tell us, how do interest rates affect these ones too, savings and investment?
Okay, so in terms of savings, high interest rates means you are getting more on your deposits. Right now, deposit rate is like 30% of MPR. So at 26.75, that's like 8%. High interest rates, T-bills are at 20%. Of course, it makes you want to save more.
At 8%?
No, treasury bills.
Okay, treasury bills. Because I'm wondering, sometimes the interest on savings account is annoying.
Yeah. So on treasury bills, you're more disposed to say, oh, I want to keep my money in treasury bills at 20%, at 21% yield.
For how long?
For a year. For a year. So it's short-term investment. So you can do that for a year. You can do bonds too for as long as you want. So it affects how. If
I now want the money before the year ends,
well, you can liquidate, but then you know that there are some charges or there are some capital gain or loss that will come with that. It also, in terms of equities markets, we know that when there's high interest rates, equities, there tends to be a bit of equities market downturn, because equities is viewed as a risky investment. So when there's high interest rates, people will just tend to do the safer investment, which is, let me put my money in the bank, let me give my money to the government, treasury bills. I get free return. In that way, I'll get free return compared to doing equities that I know that comes with a bit of risk. So high interest rates affect the equities market negatively, but it comes to fixed income is a positive one. You can just keep your money and then go to bed and sleep.
Oh, wow, I like that one. So we still have time for maybe one call. If you can call now, 0700 923 923 923. That's the number to call. There's also 0802 054 4484, or just send us a message on WhatsApp. 0817 313 6193 is Money Talks, brought to you by CFA Society Nigeria. Hannah Agbai is the guest on the program this evening, and we've been talking about basics of interest rates and how they impact financial well-being. It's been a robust conversation and an education of some sort right here with Hannah. So Hannah, how can understanding interest rates help people make better financial decisions, such as when to borrow, when to save, or when to invest, if there will be enough money to do that?
Okay, so if you have like a good understanding of interest rates, it makes you are able to make more informed lending and borrowing decisions. So you know rates are high at the moment. Is this the best time to borrow money? It depends on how urgent or how important your invest. Just like the first caller said, borrow at 26.75. So if you know that, yes, this is not the best time, I'd rather just stay on the lending arm. Let me just give out than borrow. So it helps you make informed, better lending and borrowing decision. And it also helps you know, is this the best time for me to either do equities because interest rates are low, or is this the best time for me to do fixed income because interest rates are high? So it helps you time when to either do either stock or fixed income in terms of investment. And in terms of loan, it also helps you choose when to either go fixed rate or variable rate. You know, rates are high at the moment. You can just decide to go for variable rates because you know at some point these rates are going to come down. Inflation is coming down. Because if you take it fixed, it means that you'll be paying 30% for as long as the tenor is. But with variable, as interest rate changes, you know that yes, if it's coming down, you can also refinance and then you pay it lower. So this helps you make better investment decisions.
And there's a message on WhatsApp for you. This comes from Neka. Neka says, Hannah, talking about borrowing, why is it very difficult for banks to lend money, especially to some of us who are beginning businesses anew? Okay,
so banks look at risk and your credit profile. So they are, we all know like there are 4 C's of credits. When banks want to give out money, of course, lending is one of their major business. But then they'll have to look at, can you actually repay this money? What are you investing this money in? Is it something that will bring better cash flow for you to repay us? What is your collateral? So yes, the business of banking is lending, but they also have to manage their risk in that sense. So that is why we don't see them giving out as much loans as possible, and that's why you see so many other financial institutions doing that at a very, very much higher rate compared to a bank. So they have to manage their risk.
So if they don't give money to first-time businesses or startups, how can they now grow in their businesses? Because I know from experience that startups find it's easier for the camel to go through the eye of the needle than for startups to get loans from banks.
Yeah, so startup is a risky business and everyone knows that. So for a startup, you start with your family and friends. Just at
this time, family and friends don't get money. Family and friends don't give money now. Okay, well, I understand that. So finally, Hannah, we'll be very glad if you can speak to this in just a minute because we're really out of time. Prices of things are so high in the market now, beyond the reach of the ordinary people out there. Does inflation have anything to do with interest rates? And does interest rate in turn affect income and standard of living?
Yes, of course. Both inflation and interest rates are interconnected. So when inflation is high, CBN has to fight this inflation by taking interest rates up. And what happens when they take this interest rate up? How does it affect your income? Companies find it difficult to borrow as much as they want, and if they find it difficult to borrow, it might lead to them not being able to expand, and not being able to expand, it might lead to slashing salaries. It might even lead to people leaving their jobs, unemployment, and something like that. And in that same way, it also affects your standard of living, because you are not able to spend as much as you want to, because naturally we know that inflation alone erodes your purchasing power. So both of them they move hand in hand. When inflation is high, you expect that interest rates will go high to cut it, and when inflation is low, you see lower interest rates to just aid businesses and everyone.
All right, let me just ask a layman's question. Shebi, the country is ours. We own the central bank. We own everything. Can't we just make an announcement and say, from today, interest rate is 5%, inflation is 1.5%. Shebi, now we get the country. Why can't the central bank just come out that after that MPC just say, from today, interest rate is now 6%, inflation is 2%, so and the country will be good, right?
If you go to the market, will you tell them central bank say inflation is now 2%, so reduce your price by 2%?
Oh my God, that's just what a layman will say right there.
Yeah.
But it's been a very wonderful time on the program this evening. We've been talking here this evening with a chartered financial analyst. Of course, from listening to her, you know that she really bagged that award. Hannah Agbai has been our guest on the program this evening. Hannah, of course, is a Treasury Associate at Investment One. She's responsible there for managing the trading of global financial assets. And we've been talking this evening. Our topic has been basics of interest rates and how they impact financial well-being. Hannah, thank you so much for your time on the radio this evening. We appreciate you.
Thank you. All right. Bye.
Yeah, and that's our time. Join us again next time for a fresh packet. Till then, keep making wise investment decisions. Smart. Uzechi is my name.
Thank you for joining us on this episode of Money Talks, hosted by the CFA Society Nigeria. Stay connected with us on Instagram, Facebook, LinkedIn, X, and YouTube at CFA Society Nigeria. Follow us for more financial insights and updates. Keep a date with us next time.